It looked as though U.S. equities were going to close at a record high and yet another one, and then investors got spooked around mid-morning. We saw a sell-off. What happened? We're joined by Alan Nuckman, Chief Market Strategist at Agora Financial. Alan, of course, it's hard to read the minds of millions of people, but what do you think pushed stocks down?
Right. Well, it was just one of those days. We continue to make new highs, new closing highs, like you said, in tech and the S&P. Let's remember the tech sector's up more than 10%, 11% coming in today. So not much damage is really done. We're down, about 0.5% right now. So it seems like when you see these headline numbers that the market's really on the move, but on a percentage basis, these are still very, very modest moves.
And, of course, we have seen this odd market, haven't we? Gold going up, and that's normally a fear trade, but stocks hitting record highs. So it almost looks like people are just buying everything in sight. Yeah,
it's a weird situation where you have the metal markets moving higher. You actually also had crude oil heading higher today, almost hitting 65 after it's been trading between, 55, after it's been trading between mostly 50 and 60 for the year. So you've seen a bounce there off the lows, a pretty straight up move there. You talked about gold, talked about stocks at highs, and we've also been seeing treasuries continue to move higher and rates move lower. But what's important as a trader is not necessarily what happened, but what didn't happen. We didn't make new lows in rates as far as the 10-year goes, so that would have showed another level of fear. And the VIX really hasn't reacted that dramatically. We're still below the 16 level. The 16 is a pivot that we've been trading in for the last couple of weeks. Let's remember, it was just Friday that we hit 3-week lows in the VIX down around the 13 handle. So it continues to move lower, and the stocks continue to move higher.
The U.S. dollar, though, it just keeps rocking and rolling. The Dixie, the dollar index, not far off 100 now.
Right. Right, exactly. Now, it traded between 96 and 98 for 3 full months. Then it broke out of that sideways channel to the upside. That targeted a 2-point move, which is 100. So we'll most likely see that. But again, it comes back to this, that the stock market continues to make new highs, even though the dollar's getting super strong in relative terms. And these other markets continue to move higher as well. So something's got to give. I don't know what and I don't know when, but there's always going to be opportunities. We got through earnings season, and it looks like we're going to have positive earnings growth, or very close to it for the first time in a year. So things are hitting on a lot of cylinders. It still seems to be that the money's still flowing into the equities markets, trying to get that yield with interest rates super, super low and looking to go lower.
If the U.S. dollar keeps rallying, though, won't that start to depress the profits of U.S. companies? I mean, their foreign earnings will be worth less.
Yeah, that's the conundrum. Now, we've been talking about that for a while. Now, it wasn't that long ago we were 100. We were at 102 just a couple of years ago. So I don't think it has any dramatic pressure. It's more psychological. But let's remember that the policymakers and the politicians here in America have out loud said that the dollar is strong and they want it to go down. So let's see if that's the next lever of stimulus that they can use, because they've really used all their bullets when it comes to the Fed lowering interest rates. There's not much room to go there. They had the tax cut, and we've also had a lot of money flooding into this repo market, which is supporting the stock market. So I think one of the levers left is to talk the dollar down if they can. But again, it's a situation where if the dollar goes down, somebody else has to go up. And looking at the euro currency right now, that's a product that's down on the mat and looks like it's out for the count for right now. From a risk-reward standpoint, I'm with you. I would rather be a buyer of the euro and the British pound and these other foreign currencies, because I think something could provide the catalyst. I don't just know what it is, but from a risk-reward standpoint, I think there's more upside in those currencies and more downside in the dollar.
We've less than a minute left. Goldman warning that the effects of the virus could be more far-reaching, and obviously it's an unknown quantity right now. So presumably the market will be vulnerable to scares on that front.
Right, and that's why we see the gold market where it is. You see the rush to U.S. equities, that from a safety standpoint. But still, look at how the markets behave. The markets have held up remarkably well again and again, and especially with this current instance. We continue to make new all-time highs regardless of what happens, globally around the world. We really can't shake this stock market, and to be able to say that that something could happen to knock the market, that's not very predictive. That's just a fact. We've come such a long ways. The S&P is up 5% in 2020 alone, and if you look at tech, if you look at the Nasdaq's up 65% since that December depths of 2018. It's been a straight up move.
We'll have to leave it there. Alan, thanks very much. Alan Nuckman of Agora Financial.